Hello, guys. Welcome to the second session of the course, which is also going to be bias. In this class, we'll be winding up whatever we have studied in the first session, and also I will give you some added, you can say, information about bias and some different kinds of things as well. So we'll go through all of those stuffs, and this will help you to understand how market moves between POI and liquidity. I've already told you in the first session that bias is nothing but movement from a POI, which is a point of interest, to a liquidity. Now, what are point of interests? We have already studied. Yes, we haven't gone into the depth of blocks and gaps. We will cover it in a different video. But overall, we have understood how to find a bias, what is a point of interest, and what is going to be our liquidity, right? Liquidity also, we have gone through the surface level. There are more things to it which we'll study in a different video. But overall, the most important things have been discussed with you related to bias, related to POIs and liquidities. So it's very simple. Whenever you see market creating a POI in whatever time frame, it doesn't matter, and you see a liquidity. So let's say this is our POI and this is our liquidity. Okay, so this is POI and this is going to be our liquidity. In that case, what you have to do is you have to wait for market to come to your POI. Once market taps to your POI, you go to a lower time frame. You use time frame alignment to look for market structure shift along with displacement, right? A fair value gap. So whenever you see that, you take your entry from the fair value gap, stop loss below the structural low, and target the liquidity of the same time frame in which you are watching the POI. If it's a 4-hour POI, your liquidity will also be a 4-hour liquidity. Now, what is a liquidity? In very simple words, it's a swing high or a swing low. Now, in my first session, we talked about what is a swing high. This is a 3-candle pattern. And what is a swing low? That is also a 3-candle pattern. It's very simple. What you want to see is something like this. You want to see, let's say this is a swing high, so we'll see green candles like this. But once again, the candle color does not matter, but generally you will see green candle, then you will see possibly another green candle or a red candle. Doesn't really matter the color. It's completely you can say, yeah, we don't have to focus about that. We just have to focus on whether the middle candle creates the high out of the 3 candles or not. If that's the case, then we have got a swing high in place, right? So here you can see the high created by the middle candle is the top among all the 3 candles. So this is a swing high. The opposite can be said about a swing low. So we want to see this kind of swing highs and lows being created, and this is what we call as liquidity in very simple terms. Like I said, there are more terms of liquidity that we will be coming through in a separate video. But for now, this is what you have to keep in mind, that liquidity means swing highs and swing lows. That's it. Also, you can mark the higher time frame candles highs and lows, like the weekly candle high and low. Both of them will be acting as liquidity. The monthly time frame high and low, they will be also acting as liquidity. Okay, so I hope till now it's very clear how to find the bias of a market. You have to find a POI and you have to find the liquidity. And once market taps the POI, you go to the lower time frame, use your time frame alignment, look for market structure shift, and once you see that, you will take your entry from the fair value gap that it creates, or you can also take your entry from the order block. It is not necessary that you have to always take your entry from fair value gap. Now it depends, because sometime market will come to your fair value gap and displays from there itself, or at times it can also come to your order block, which will be below the fair value gap, and from here it can go to your direction. So anyhow, this is the structure in which the market will move. Market will come to your POI and then market will go towards your liquidity. Now this is what we call bias. Okay, so let's say we have got a POI over here. So this is a POI, right? And this is our liquidity, right? So this is a POI, this is our liquidity, and market comes down like this. It taps our POI, gives displacement, creates market structure shift, comes down, taps into a fair value gap or an order block. Let's say it taps into a fair value gap, and from here it starts pushing higher. Now, when it will push higher, do you think that market will directly go towards our liquidity? No, right? Let me mark it once again. This is a POI and this is our liquidity. Okay, so market will not directly move from the point of interest to the liquidity like this. What will market do? When market has dropped from this high to this low to our POI, market has also created some POIs over here, right? So you will see some POIs being created over here. So this is also a POI. So what market will do is market will go to this one, and from here market will give rejection. Now when market will reject from here, it can do two things. Either market will drop completely down, and if we have taken our entry from this fair value gap, stop loss below the low, and targeted this liquidity, which I told you is going to be our target, in that case you can hit your stop loss or you can get out at break even, right? So in that case, what do? In that case, you have to understand that this is a POI which market has created while coming down. That means that when market will tap into this zone, there will be reaction from this zone. Doesn't mean that market is going to come down all the way to take out our stop loss. This is just a normal reaction from a higher time frame POI. I'll also show you examples to make it more clear. Okay, but you have to understand that our higher time frame bias is to the upside. Our higher time frame is telling us that market should move from this POI to our higher time frame liquidity. Now, this is the analysis that we have done. This is what our bias is telling us. This is what our analysis is telling us. So in that case, what you have to see is when market rejects from this POI, you have to see whether when market pushed higher, did market create any kind of POIs over here or not. If market created some POIs over here, you can expect that this is going to defend this market from going down, and from here market can once again push higher to target our final liquidity. So this can also be explained or understood by a mirror concept. That means what? That means, let's say once again that we have got our liquidity over here, and this is our POI. Okay, this is our higher time frame POI. This is our higher time frame liquidity. Let me mark it once again. So this is our POI and this is our liquidity. So now we are entering from this POI, right? So when we have entered from this POI, like I said, market is not directly going to go towards our liquidity. So what you can expect is that market will push from here. It will show displacement, right? In the lower time frame, it will give us confirmation for entry. We will make the entry. Now, after we make the entry, once market pushes higher, do not expect that market will directly go and target your liquidity. So let's say that this is a mirror, and from here light is getting reflected. So once light will get reflected, let's say we have got a mirror over here. What will happen? Market will reflect from here, right? Once market reflects from here, let's say we have got another mirror over here. Now, what are these mirrors? These mirrors are nothing but POIs. These are also POIs in the lower time frame, right? Let's say we have taken our entry from the weekly POI. So this is a weekly POI. But these POIs, let's say these are daily POIs, right? So in the daily time frame, these are hurdles for market to push higher, right? We're expecting market to push higher because our analysis is telling us. But like I said, in the daily, these POIs are what? These are hurdles. So market will not directly break these hurdles. Market will show reaction from these hurdles. Now there is another daily POI, like I said, like a mirror. So market will come down, tap into this POI, or you can say light will come down, reflect from this mirror, and then it will push higher once again. Now once it goes higher, there will be another POI over here, let's say. So let's say we have got another mirror over here. So once again, market will get reflected from that POI or from that mirror, and then market will create some new POIs over here. Market will tap that new POI, and from there market will go towards its final target, which will be our higher time frame liquidity. Now this is how ideally market moves. So this is the structure in which market will move from a POI to a liquidity. Market is not directly going to move from a POI to the liquidity. There will be lower time frame hurdles. This will be called as hurdles to our direction, because we are looking for market to push higher. We are expecting market to push higher, but in the path to the higher direction, we have got some higher time frame POIs. Now remember, this daily POIs will be showing rejection to the market, and market is going to react from these zones. But you have to understand that these POIs are not higher than our weekly POI from which you have entered. So that means even though in the shorter time this will show rejection, but they do not have enough capability to completely reverse the trend and come all the way down to take our stop loss. This is something that you have to understand. Higher the time frame, stronger their POIs are. Okay, so since this is a weekly POI and this is a daily POIs, so you cannot expect that once market taps a daily POI, market will completely reverse from there and take your stop loss. Okay, so you have to understand that the higher time frame POIs are more dominant than the lower time frame POIs. So this is something very, very important. When you do your analysis, when you find out your bias, you take your entry. Let's say you take your entry from here. After confirmation, you make your entry, stop loss goes below the low, and you target the weekly liquidity. But you see market starts to drop from a POI over here. Let's say we have got a fair value gap, a daily fair value gap over here, which is at POI. So from here, market is showing rejection. So what do? If you panic and if you close your trade instantly, then you are going to go into loss. Why? Because your analysis was correct. You should have faith in your analysis and you should hold your trade according to your analysis. That's very, very important. So when you see that weekly is a higher time frame POI than a daily, then you have got the faith that the daily POI is not capable enough to push this market completely to the downside. Why? Because this buy is coming from a weekly POI, right? So weekly is obviously higher than daily. So that means weekly has the capability to push higher. So for that, once market drops, from which level can market turn again? So for that also, you will see that there will be some POI which will be created in the daily, and from there, market will continue the higher direction. So now I'm going to remove this and I'm going to show you this exact example of gold and show you how exactly market followed this path that we just talked about. Okay, so let's see over here once again. In the first session also I gave you this example of gold. Here you can see we have got the weekly POI, right? This is a weekly POI, and from here market came down, tapped and gave us a strong displacement. Now what is going to be our target? Since this is a weekly POI, we will have two targets. Why? Because we have got two liquidities. This is the first one, right? And this is the second one. So weekly is giving us two targets. So we'll target first this high and then this high. Now let's go to the daily time frame. So now we have come to the daily and we can see here, let me just keep these levels in all the time frame. Okay, all intervals. Let's go to the daily now. Okay, so now here you can see in the daily what market did was market created some POIs over here. Do you see? So we have got the daily order block over here, and market has given us a strong inverted hammer candle. Now if you close your trade over here, then you are going to be in loss. Why? Because you would miss this move to the upside towards your liquidity, which is your first target. So in that case, you have to have faith your analysis. See what market did when market pushed higher, tapped into these daily hurdle, this daily POI, which is against our direction, which is against our bias, market gave a reaction from this zone, but market did not come all the way down to take you out. What market did was, while pushing higher, market created an order block over here, which market tapped, and this order block act as a defense against gold going lower. And from here, gold started to push higher once again. It took out this liquidity, and after that what it did was it once again came down. And once again you can see what happened. Market created a new defense order block, and from here finally it went up to target our liquidity, right? This was our first weekly target, which was hit. So once market hits here, you can expect that market is going to drop. Why? Because there was no candle closing. So whenever liquidity is taken, either market is going to drop from there, tap your POI, it will tap into that POI, and from there it is going to continue higher. Or what it can do is it will spend some time over here, it will just go sideways like this, and then it will break this, create a new swing, and continue higher. These are the two ways how market will move after it takes out a liquidity. Now I've already told you that when market drops, taps into a POI, goes towards a liquidity, this is a bias. POI to a liquidity, right? This is called bias. POI to a liquidity. This is called what? This is called a bias. Now, once market takes out the liquidity, I have told you there can be two things. Either after market takes the liquidity, it will drop, tap into a new POI, and from there it will continue the trend like it did over here. You can see after market tapped into this daily order block, market went up, took out the liquidity, and after taking out, this is the daily liquidity, right? So we're talking about the daily now. So in the daily, market came down, tapped to the POI, and from here market pushed higher, took out this liquidity, and after it taking this, what happened? Market could not directly continue higher. Market gave us a pullback to the order block, and then market continued higher. So this is a move from liquidity to POI, right? This is a move from liquidity. Now we're talking about this after market took out this liquidity, market dropped to a POI, right? Now this is against the trend. Our trend is on the upside, but this is a counter trend move, right? So this is the direction between a liquidity to POI, and this is called reversal bias. This movement from a liquidity to a POI is called a reversal bias, and this is against the trend of the market. Okay, and we generally do not trade this reversal bias market condition, market structure, because this is against the trend. This is just looked at as a correction, and once market taps into our POI, once again we look for an entry from our POI to target the daily liquidity. So this is once again a bias. And here, once market took out the liquidity, what happened? Once again market started dropping. Now this time market did not have any POI over here. The only POI was over here, which market did not respect. Market dropped further. So in this case, what market did was, since there was no POI, market took out this liquidity. This was just a liquidity strip, even though the candle closed below. But if you go to the lower time frame, you will see that you would see displacement, and from here you could have taken a buy entry because this was just a liquidity sweep. So this is a move from liquidity to a liquidity. Do you understand? So now I am showing you multiple examples of how market moves. Initially, we have studied a very simple structure of how market moves, and this is called a bias. Bias means what? Bias means simple market moving between POI and liquidity. Okay. Now, second thing that we have studied today is called reversal bias. Reversal bias means what? Reversal bias means that, let's say we have got a liquidity over here. Let's say we have got a POI over here. And let's say market comes down, taps into our POI, goes to our liquidity. Obviously it won't go like this, but just to give you a demonstration. Okay, and once market takes out the liquidity, it does not continue directly to the upside. Instead, what it does is, once market takes out the liquidity, it has created some kind of new POI over here. So it is going to drop to that POI, and then it is going to continue its direction. So this move from a liquidity to a bias, this is called reversal bias, and generally we do not trade this market structure because this is a counter trend setup. Okay, but this is called what? This is called reversal bias. The third thing that I have shown you today is that it can happen that even though, let's say we have got a POI, we have got a liquidity over here, market comes down, taps into the POI, and then goes to the liquidity, and let's say market creates some kind of an internal POI over here. Let's say I make it like this, market drops, and then market goes like this. Okay, so market creates this POI over here, right? And now after taking the liquidity, market drops. So you were looking for an entry from this POI, but market does not move from the POI. Market comes all the way down to take out this liquidity, and then market moves from here. So this is a move between a liquidity to another liquidity. Obviously, you won't focus on the liquidity itself. Your focus will be on the POI for looking for an entry towards our new liquidity, which will be now at this high. But if you do not get confirmation from the POI, what will be your next move, next level to watch for? It is going to be this liquidity. Now this is a move between a liquidity to a liquidity, and this also happens in the market, right? Now these are the three, you can say, most common type of move that you see in a market. First one is bias, which will be trading. Second one, and bias is between a POI and a liquidity. Second one is a reversal bias, which is after market takes out the liquidity, then market will give a move to a POI before continuing in its direction. This is a move between liquidity and a bias, and this is called reversal bias. Now we do not really trade this setup because this is against our higher trend. The third move can be between a liquidity and a liquidity. Now if there is a POI, market comes down, taps into the POI, but no displacement is seen, then it will focus on the liquidity just below. Now what will be a liquidity? Liquidity, I've told you, it's going to be a swing high or a swing low. Now in this case, this is a swing low, obviously, and that's the reason we're focused on this low. So once market takes out this low, we will use time frame alignment to look for an entry, just like we do when there is a POI, and from here we'll be targeting the liquidity of the same time frame. Okay, very simple. And the fourth thing, how market moves. Now these are all the ways how a market moves. The fourth thing is when market is creating something like this. It's in a consolidation phase, right? Now this is a move between what? Between a POI and a POI. This is a move between a POI to a POI. So we will see that there will be some POI over here which market taps and market rejects. Then there will be some POI over here, and here also market will react. Then there will be some POI over here. From here also market will react. Here there will be some POI. From here also market will react. Now this is also a typical movement inside a market which happens when there is a major correction. In Elliott wave, we call this a triangle pattern or a channel pattern, but we don't want to bring that over here. This is basically a POI to a POI move, and obviously we do not trade this kind of market structure, but this is just a consolidating move. Market is not hunting liquidity in any direction. All the swing highs and the swing lows are protected, right? And the POIs that are created in the swing highs, they are being tapped and market is moving from there. Okay, so these are the four ways in which market moves. First one is bias, in which market moves between a POI and a liquidity. Second one is a reversal bias, When market takes out a liquidity, then it drops to a POI, and from there market will continue the trend. Now this is called a reversal bias. Okay, so this is a liquidity and this is a POI. Third one is between a liquidity and a liquidity move. Now this is also common in the market, especially in gold. You will see movement between liquidity and liquidity, even though there is some POI, but market is not going to respect the POI. Market will come to the liquidity, hunt the liquidity, and then we will use our entry model, which will be market structure shift, and we will be taking our entry from here and we will be targeting this high. Okay. Fourth one is a movement between a POI and a POI. When market starts to consolidate, it starts to range, the price action starts to become narrower. You see trend lines being formed on both directions. This is a movement between a POI and a POI. So these are the four ways in which a market can move, whether it is in a strong trend, this will be our bias. Whether it is in a pullback, a correction, this will be a reversal bias. Whether obviously in the strong trend, you can also include a liquidity to liquidity move. And when market is consolidating, you can expect that this is a move between a POI and a POI. Okay. Now this move between liquidity to liquidity, this can also happen when market is moving within a narrow range, something like this. Basically when there is no volume in the market, this is also called AMD, basically accumulation. Then market will create this kind of lows and highs which will stay intact, and after that market will take out either the high or the low, and then market will give move in the opposite direction. So this is called an AMD in terms of ICT. This is accumulation, this is manipulation. Manipulation is taking out a liquidity on either of the direction, and third one is distribution. Okay, so this is also a liquidity to a liquidity move. So market took out the high liquidity, the high, right? This high has been taken, and then market drops and targets this low. So this is also what? This is also a liquidity to a liquidity move. Now, what are the, you can say, structures that we'll be looking to trade? So it's going to be our bias. This is what we'll be looking to trade. Between a POI and a liquidity, we will mark our POIs, we'll mark our liquidities, we'll look for entries from our POI using market structure shift, and we'll target the liquidity. This is what we will trade. And we are also going to trade this model between liquidity and liquidity, where market takes out the liquidity and then market pushes higher to our liquidity. Here also we can use the same entry model. Okay, so these are the two entry models that we will be trading. We won't be trading reversal bias where market moves between liquidity and POI. This is not something that we want to trade because this is against the trend of the market. This is you can say this forms when market is moving within very narrow range, and once again we are not interested to trade this kind of market condition. Surely I will share a setup as mechanical strategy, basically in which we'll be using this concept of AMD to take entries, but we will keep it for a separate class. But for now we are not going to look for this kind of trading models. POI to POI once again is not a tradable market because market is just stagnating over here, squeezing the price action, and any moment it can break out in any direction, right? Okay, so we do not want to get into that. So these are the two basic entry models that will be trading. Our bias between POI and liquidity, and second one would be a liquidity to a liquidity. Okay, now this is a higher range direction where market is moving between a massive liquidity to a massive liquidity. That means the distance between the liquidities are, you can say, respectable. They are far away from each other, but in this case we're not going to look for an entry, like I said, because this is a very close range market movement where there is not much volume in the market. So we're not going to deal in this one right now. Okay, so this is what I had to talk to you about liquidity today. And bias and reversal bias, those are very important to understand. And I think till now you have understood how to find the bias of the market. It's not going to be very yeah, it should not be problematic to find out the bias of the market. And I also told you how market is going to move. You can see exactly market move like that. If you look at this daily POI, from here market move, took out the liquidity, then market drop, tapped into this POI. From here market took out this liquidity, and after market takes out liquidity, like I said, market can give us a pullback to a POI before pushing higher, or it can also take out a low, which is a liquidity, before pushing higher. Okay, but the strength to hold this trade from our weekly POI to our weekly targets will be coming from the weekly analysis. If you look at the daily, then obviously you will see that market has taken out this high. Now market can reverse all the way to the downside. The answer is that's not going to happen because the buying is coming from a weekly POI, right? In that case, you have to understand that the daily POIs, which is showing rejection, they are going to be overtaken from a daily POI as well. So you can go to the daily and see the structure, and you can also look for new entries from these daily POIs using time frame alignments that I have told you, and you can target the daily liquidities. If you take your entry from the daily POI, then what will be your target? Your target is not going to be this high or this high, it is going to be this high, right? Because this is the daily liquidity level. So this is how market moves. This is the, you can say, the gist of how market moves, the fundamental of how market moves, and you can find the exact same kind of price action or movement in any kind of market, whether it is stocks or crypto, doesn't matter. In every kind of market, this is the way market actually moves. Okay, and one more thing I want to tell you is that I have told you about order blocks, about fair value gaps, about imbalance, and I want to give you, you can say, a hierarchy. So order blocks are more powerful, then comes imbalance, and then comes fair value gaps. Okay, so this is also something that you can keep in mind, but these are all POIs and you will be focusing in all of them. You will be marking all of these in your chart and waiting for market to come to these zones, and you will be using your entry models using time frame alignment and look for market structure shift to make an entry. But this is just to give you an understanding that if fair value gap does not hold, then we'll focus on the imbalance. If you see an imbalance like volume imbalance, gap imbalance, I will bring a separate video on them. And the most important of them is the order block. If order block does not hold, that means we might see more pullback, a more deeper pullback. In that case, we'll focus on much higher time frame POIs. Okay, so this is also something that you have to understand. Let's say market moves like this and we are watching in 1 hour, and in 1 hour, let's say this is the 1 hour time frame. This is the 1 hour time frame, and in 1 hour we see that market has created some POI over here. Let's say we've got an order block, but market drops and market breaks this low. In that case, does that mean that the market has become bearish? The answer is no. So when that happens, the 1 hour POI is getting disrespected. What we will do is we will shift our focus from 1 hour to 4 hour, and we will try to find some kind of a POI over here. So maybe in 4 hour you will see that market actually has some POI. Obviously the price action will get squeezed, and maybe you will see that in 4 hour market has done something like this. Market has taken the high, wicked on the high, and then market drops and market breaks low, right? So this is the breaking of the 1 hour low that you see over here. But in 4 hour you might see that there was only a wick on the upside, no candle closing, and market dropped. And in the 4 hour you might see an order block over here. So that means now you'll focus on this order block, and from here you'll be looking for an entry. And what will be your target? Your target will now become the 4 hour liquidity, which is going to be this high. Yes, there can also be swing highs over here in the 4 hour. If that's the case, then I will focus on that as your first target. Let's say we have got a 4 hour swing high over here, then you will be targeting this high. Okay, so this is how you have to see. Let's say the 4 hour also breaks below this low. Let's say the 4 hour is also not able to push gold to the upside and it breaks below the last low. In that case, what will you do? Will you look for a sell entry? Then the answer is no. You will go to daily POI. Okay, so this is the 4 hour POI. Okay, this was the 1 hour POI. and now you go to the daily POI. Why? Because the 4-hour has been broken. So now you focus on the daily POI, and now you watch for daily move. So maybe in daily you will see that market has given a strong week, because in 4-hour, if market drops like this, then you will see a closing with a big week on the upside, something like this. Let's say you see a red candle with a massive wick on the upside, something like this. In that case, you will focus on the daily POI. So let's say in the daily we've got an order block or something like that. So we'll be focusing on this zone, and from here you'll be looking for an entry using entry model, which will be market structure shift, and your target will be the daily liquidity. Okay, so this is how you watch the market. And using the same kind of analysis, I actually did my analysis over here when market gave this massive correction. Initially, I was watching for 1-hour POIs over here. So in the 1-hour, I can see that we have got nothing over here. Market dropped. So this was my POI, right? Because this was the last order block. And I was watching for an entry from this zone, but market did not give me an entry. When that happened, I went to the 4-hour. In the 4-hour, I was watching for an entry, and in the 4-hour also, this is the same zone as the 1-hour zone, and from here also market could not push higher. When that happened, I moved to the daily. In the daily, I saw that market has given multiple fair value gaps, and when that happened, I told you either the first one will be the most important. Yes, there was a reaction, but market could not continue higher, or the last one. In this case, the last fair value gap is this one, right? And apart from that, we have also got the daily order block candle. Now this was the zone that I was looking for an entry, and yes, market actually failed to close below this low and gave a strong displacement. So that's the reason I was looking for an entry from the zone. And also this was a weekly POI as well. If I take you to the weekly, then in the weekly, this is going to be our order block. So as long as market completely shifts its structure to the weekly time frame, you cannot say that market has reversed. For it to reverse, it needs to completely flip the structure till the weekly time frame. Then you can say that yes, market has become completely bearish. Till then, if 1-hour POI does not hold, you go to the 4-hour. If 4-hour does not hold, you go to daily. If daily does not hold, you go to the weekly. And this is how you do your analysis, and you look for reactions from the zones, and you look for your entry, and you target the liquidity of the same time frame. Okay, so this is all about bias that you needed to know. Now you apply the same thing, practice this in whatever stuffs you trade, whether it's crypto, whether it's Forex, or whatever it is, doesn't matter. The same concept can be applied for all of them. Okay, so that's all in bias that you have to know about. In the next class, we will go to the POIs, we'll talk about the blocks, then we'll study about the gaps, and then we'll talk about liquidity, and then we'll go into more depth on how to read the market structure. We'll do structure mapping. We will learn how to read the internal market structure and also the external market structure. Okay, so that's it for today's class. Hope it was helpful. Hope you had fun. Now keep practicing whatever you are learning. So that's it for today. I will see you in my next class. Till then, take care and trade safe.